All right, we are live again for Tax Talk number 10. So that's really exciting that we've now hit 10 weeks in a row of our live Tax Talk with Ethan Rooshock. And that's really exciting for me because after doing the first couple, I didn't know how well it would go. So in that time, a few things have changed. We've got a microphone here, we've got a camera, which has all improved the quality, hopefully, from those that have watched the first Tax Talk live. So for those that are new here, we do a bit of a pre-show quiz. So I will bring that up so people can start putting their guesses in. And today's is multiple choice. So it says, one couple tried to claim a wedding that cost how much according to the ATO? So we've got four options. So option one is $73,000. Option two is $140,000. Option three is $22,000. And option four is $58,000. So feel free, if you're watching on Facebook, over on YouTube, to leave your guess of what you think that answer is. And then what I'll pretty much will do, I'll run through what happens here, and then we'll go into the answer to that. So for those that are joining me, so I can see a few people are already joining on Facebook and on YouTube, which is really cool. So if you are, hit the like button on either of them. That really helps me get this out to more people. Is on these live sessions, I'll have a topic. So tonight's topic is going to be tax deductions. We're obviously coming up to tax time. So I'm just going to talk a bit about tax deductions in general, about how they work from, what actually constitutes a tax deduction from, what's allowed by tax law, also what's happening as far as when you're spending that money, etc. And just a few of those things around deductions. I'll talk about some of the new series I'm doing on tax deductions. And then I'll go into a few questions that were asked through the week. So again, you can ask questions, whether it's over on Instagram, Facebook, YouTube, anyway, get in touch with me and I'll answer them live on this video. So I do this each week for Wednesday nights. And then if there's any questions that come in during the comments, so feel free to drop a question. It doesn't have to be about tax deductions. It can be anything tax related, anything business related, or crypto related, crypto tax, all those kind of things. So that's kind of how tonight will go. Hopefully we'll go for about half an hour like normal. And yeah, so I can see we're starting to have some guesses come here through for the quiz. So we did have a guest that come through. So we've got, unfortunately, can't watch live tonight. We'll watch later. And then this is a regular to the channel, and he's guessed, I'll guess B if there's multiple choice. So I guess we've got one guess at 140,000. And we've got a few other guesses here. So we've got 58,000. We've got another at 58,000 and a third one at 58,000. So I'll give you a bit of backstory quickly to where this question come from. Is that the ATO, I think it was last year, released a bit of an article on some of the funny things people have tried to claim. So one of them that I do remember was a Lego set. So someone tried to claim Lego on their tax return. So, yep, that'd be cool if we could claim that. I do have my Iron Man, which I'll grab over here. So that would have been cool if I could have claimed the cost of that. But yeah, one of the things they mentioned was this wedding that someone had tried to claim. I think it was a couple people have tried to claim the cost of a wedding. So someone had tried to claim the cost of a wedding, and they'd actually split it up over two tax returns, so a husband and wife. So I guess that's been a little bit creative to go, well, I guess the wedding's a joint cost and, we'll split it up. Maybe it won't sound as bad. So obviously they got ordered. Obviously it was quickly said, no, you can't claim the cost of a wedding. So, all right. So if we haven't got any more guesses coming in, the answer was $58,000. So we've got three correct answers tonight. So yeah, someone had tried to claim $58,000 through their tax return of their wedding. So hey, creative way. I've got a wedding coming up next year. Hey, if I can think of a way to maybe make it claimable, that would have been cool. But I don't think the ATO are going to allow that. So yeah, that was quite an interesting one I found. So each week I'll chuck another question up there and just creates a little bit of fun while we get a few people to join. So yeah, congratulations to those that got it right. The only one that got it wrong was one that pre-guessed with a guess of B. So yeah, maybe pre-guessing might not work too well. So as I said, tonight's topic is going to be tax deductions. So pretty much what I'll do here is talk about tax deductions in general. I've got a few different kind of bases of what I want to talk about. I will quickly touch on, I have started a little bit of a series. So the first one came out the other night of tax deductions for a particular industry. So first I covered teachers. So I talked about tax deductions from a teacher's point of view. I just covered 5 simple tips in under 5 minutes of what you potentially could claim as a teacher. So obviously any kind of tax stuff I talk about is generalized. Everyone's situation is going to be different. I have to harp over that every single week, but at least I'm going to give you an idea of, okay, look, if you're a teacher, think about these ideas because, these are what are commonly claimed. obviously dealing with a lot of people, I start to go, okay, which occupations have which deductions? So obviously I know with a teacher, we talked about things like union fees, we talked about resources. So that's one of the unique things that teachers have, is they're going to have, resources they're buying for the classroom, books and stuff like that they're using within the teaching. So that's kind of one of the areas that I cover. So I want to cover more industries. So if you can leave a comment of what's your occupation and do you want me to cover that and go through, okay, what are the common things for nurses is definitely one, tradies. I want to talk about things that are common. That way you can start thinking about these things when you're preparing for tax time, going, okay, a lot of tradies, for instance, are claiming tools. Do I, have I got tools that I expended through the year? Where are the receipts for those? So that's kind of the things I want to do. Now, I can see I'm having a few issues here with internet. So if someone can let me know if it's flowing and streaming all right, because, I've had a lot of internet troubles today. So one thing I want to talk about with tax deductions is the timing of a tax deduction is obviously going to determine when it's going to be claimable. So that's going to be something coming up to the 30th of June, is it needs to go on for a basic individual return. We're going to talk about when it is expended. So those tax deductions, if you're wanting to get them in, they need to be in before the 30th of June. So prior to, that is going to be really important because that's your documentation. If you get an audit done on you, you've obviously want to have something to back you up, and therefore the receipt's important. So therefore your date needs to be important. Check your receipt. I've seen it, obviously big stores, you shouldn't have an issue, but I've seen some smaller stores where their point of sale system may be out of date, out of whack, and it gives you a date that doesn't support your claim. And, you don't want to be getting an audit and miss out on a claim in the year that you've claimed it in because you had a dodgy receipt. So check those things when you're happening. So that date becomes really important. We've spoke about it on a few episodes about depreciation, so those over $300 expenses, how they work. But in general, that date is going to be really important no matter what. So when you're sorting your receipts out, make sure you collect the right. And they've got receipts everywhere, and that's last. Yeah. So okay, hopefully we're back. See if this is working. I do apologize. Of course, it would happen 10 weeks in that we start to have some technical issues. So if anyone can let me know if it's working a bit, I do really apologize for this. So the joys of doing something live. So we'll see how we're going. If anyone can just let me know before I go back into it. I've tried to switch to a hotspot on my phone to see if that works better. So the joys of internet. So I'll just wait. Yeah. All right. I think we're going. We'll try again. If not, what I will do is anything I do touch on, I will try and the video will stay up on the channel. So hopefully it will work a bit better then. So I'll keep recording unless we completely drop out and we'll go from there. So I'll just go back to that. So the timing of a tax deduction is really important. And if there was anything I did miss in it, then make sure you ask that question if anything did cut out. So the timing is really important and making sure that date is correct. So we've got receipts and we need to make sure that those receipts are showing the correct dates, because obviously if you don't have that, it's going to cause issues. And then making sure your receipts are organized in a way that actually makes sense. So don't come into your account and go, oh, yeah, I've got this receipt. And then they go, oh, that's from this year, or, that's from last year. And you've got them all mixed up. So you want to make sure you've got those receipts sorted. So I've had that before. People come, yeah, here we go. Here's this. And I go, well, that's from July. That's from 3 days ago. That's not relevant. And then they chuck it out. They chuck it with that lot and then they never claim it. So you're missing out on legitimate deductions there. So that's really important in being organized kind of thing. So the main thing with the work-related deductions is it actually work-related. So I know that sounds like a bit of an obvious one, but to be claimable, it's going to need to be work-related. It's going to be related to earning your income. And that's the kind of key that you need to keep relating it back to is, was this an expense in relation to me earning that income? So if you can't meet that test, it's not going to be deductible at all. And what's really good is there's so much free information out there from the ATO. They've got so much good, examples of what is deductible and what's not. So even if you're not doing your own return, you can still do some basic research to kind of have an understanding of what you're going to be able to claim, or have an idea that, okay, I think this might be claimable. I need confirmation. I'll be able to at least ask my accountant about it. So that's the kind of, is it work related? So a really key example one is uniform, where people get it wrong. If they go, oh yeah, I bought that for work. And that's what I'm saying. That's not enough always to make it there. So this isn't work related, isn't the sole test, but at least it's going to be a starting point. So I'll touch on uniform because that's a common one that, quite often happens across a lot of occupations, is that with your uniform, plain clothes that you wear to work aren't deductible. So if you're, do you mean me, I'm wearing this now, it's not a work-related shirt. I'm like, oh, yeah, but I wear that to work. I can claim it. Well, no, you can't. And that goes to things like that have got a logo on it. Obviously, that's going to be deductible because, it's logo. You wouldn't wear it for anything else. And that's where, like, say, common, a suit, that isn't work. That while you might be wearing it for work and you think, oh, that's work, that's a deduction, it's not deductible. So, and these are common things that you can find on the ATO website. If you do a bit of a search, they go into some of these things in more detail. So that's why I want to do these videos on different occupations, because it's just going to give me the chance to, dive in deeper, because things is like a common deduction might be common for a particular occupation, but not for everyone. So like, a retail assistant is going to be very limited and, they might not have that. But then there might be someone else, they go, I claim my phone for work. And then the retail assistant goes, oh, well, I can claim my phone. They did, but they're in a different occupation. So each occupation is really going to kind of have its own set of common deductions. But then again, you still needed, and this is going to lead into my next point here, did you actually pay for it? So to make a deduction claimable, you need to have actually paid for it. You can't just go, oh yeah, I'm going to claim I use my car for work, but you didn't actually use it. Or I got some work uniform, but no, I didn't actually pay for it. Oh yeah, but you can just claim a standard. No, that's not how it works. You still need to have paid for it. You need to have incurred the expense for it to be a deduction. So I know that sounds like quite common, but it's, people get that confused and go, oh yeah, we'll just claim the standard. I'll claim me $300 in tools. Well, that's not how it works. I mean, you can do that. Go ahead and do that, and you get an audit, and the ATO go, okay, well, what was your thing? Oh yeah, I just claimed the normal. There isn't a standard deduction for most things. Like, there might be standard common law people doing a similar which is a work clothes, and therefore that's where it kind of comes in that people go, oh, that's a standard deduction. But again, the ATO is still saying, okay, yeah, there might be common that a lot of people, so that's where, that term standard deduction might come from. But you still need to have actually incurred that expense and to make it a deduction. So don't just go in and go, yeah, just claim the usual, because, that's not what it is. And that's something they release things each year that they're looking for. And one of the things I've seen recently in the media was, don't just claim the same as what you claimed last year. It's very unlikely you're going to have the exact same set of claims from the year before. Even look at something common like phone. You're not going, yeah, look, I do use my phone. It's 25% for work. That doesn't change much year to year. But your phone bill is likely to change. Phone plans go up, phone plans go down. You might, that's going to change quite often. So make sure you're checking these things. You don't want to disadvantage yourself. It's something I spoke about on the teachers thing with union fees. Union fees quite often go up. And people just go, yeah, it's the same as last year. But was it? Like, if you're paying an extra $200 for the year, make sure you're claiming that. Don't disadvantage yourself just because you were lazy. And I think, unfortunately, the biggest reason why people don't get the refunds they deserve or, actually claim the deductions they deserve is laziness, that they, they're unorganized and they can't be bothered. And, yeah, don't worry about it. I don't know where it is. Well, spend that 10 minutes looking for those receipts and, you might get a few extra $100 back. Makes my job as an accountant easier. If you've got receipts, well, then I can legitimately claim stuff. I know that, okay, yeah, you've got that to back that up. Like, doing that little bit of time beforehand is really going to help you with tax deductions. So that's kind of some of the things that I want to talk about. again, like if you've got an industry occupation, or you've just got a question, do I think this is claimable? Chuck it in the comments and I'll get to it. So again, we want to make sure it's work related. It was required for work. We want to make sure what date did we buy it and did we actually pay for it? They're some of the key things you want to think about. Like I said, go on the ATO site, do some research yourself, because there's lots of good free information out there. And that's what I'm trying to do with these videos that I'm doing of, I've done the video on teachers' deductions. So I want to go, okay, look, if teachers are, doing YouTube search on tax, they've got an idea of where to start. Obviously, that's not going to answer their particular questions, but it's just going to give them a starting point. So like I said, want to cover nurses, want to cover trades, want to cover those major occupations so that people have got a reference point as a starting point, whether you're doing your own return or using an accountant, etc. So I will chuck in a cheap plug halfway through, obviously, that, if you do want a tax return done, feel free. I'm taking appointments now. I'm also trying to get in the process of we do returns via online methods, email, Facebook Messenger, anything that suits you. That can be phone appointments. It doesn't have to be in person. So, and this year our fee structure is up on our website, but a basic tax return is going to be $79. We also then obviously have all our crypto tax packages for those that are invested in crypto. And then obviously you can do your more advanced stuff with rental properties, investments, shares, all that kind of stuff. So I don't like to plug too much on this, but thought I'd quickly drop that in. So what I'll do now is jump in. I did have a question asked during the week. If anyone does have any questions, make sure you do leave a comment and I will get to them after I finish this one. So this one was relating to rental property. So the question was, planning to put and I've had to cut a little bit of this because I only get so many characters in this thing, but planning to put a property for rent within the next 2 months. Could I start doing a mini reno and replace old depreciation items and allowed to claim even though I spent on it before being on market? So this is quite a common situation. You've got a property and you go, okay, I'm going to rent it out, or, I've moved out, and I'm going to rent it out. And quite often these properties, unfortunately, are going to need some prep work to make them ready. So unfortunately, you aren't able to claim. So the way the ATO, I'll try and find the exact wording on it from the ATO, but it's something on the line of, this comes straight from the ATO website. So expenses prior to property being genuinely available for rent. So you can claim expenditures such as interest on loans, local council, water and sewage rates, land tax and emergency service levy you incurred during renovations to a property you intend to rent out. However, you can't claim deductions from the time your intention changes. So it's a little bit confusingly worded, but pretty much you're not going to be able to claim those expenses up front. And a lot of big major renos aren't going to be claimed up front anyway. So we have a thing called depreciation. I've talked about it a bit before, but you're going to claim these over the life of the asset. So you can't go and do a, $50,000 renovation on your kitchen and bathroom and expect to claim all that in your tax return. It just doesn't work like that. So if you are doing major renos to the property beforehand, you're going to still be able to claim them somehow. And it will likely be that they'll help form the cost base if you sell that from capital gains point of view. So, if you've done you buy a house, you do a major renovation, major upgrade, you then rent it out for, a few years and then you go sell it. Those renovations will all add to the cost base. You might have paid $150,000 for the property and done another $50,000 of renovation. So the cost base may become $200,000. And that you may have depreciation once you actually start renting it out. So again, it's just going to depend on the type of item. So renovation can mean a lot of different things to a lot of different people. For some people, renovation might be going around repairing a few things that are broken and doing a bit of a paint job. And for someone else, a renovation could mean adding 3 rooms on the back and stripping out a bathroom and kitchen. So it's going to depend on what you're doing and the nature of it and, how much you're spending on these things. And then obviously that timing is really going to be really important when it comes to rental properties is the property genuinely available for rent? And then obviously what your intentions are. So that's some of the things you've got to consider with rental property expenses. So that was the question we did have. I can't see too many questions coming through. So unfortunately, we've had a few technical issues tonight, which is a real shame. So I will touch on a few other things that I've got going on. So what's something I just want to talk about was exciting today is I was a guest on a podcast. So hopefully that will be coming out next week. So now I want to get this name right. I'm 95% sure it is Further Your Lifestyle. It's the name of the pod. You do these things and you listen to these things and you don't always remember. I listen to this podcast all the time on Spotify. Now, let me just double check. I think I've Yes, I've got that right. Yeah, Further Your Lifestyle. So check that out on Spotify, and stay tuned for hopefully within the next couple of weeks my episode will go up. So that was a really exciting chat because I got to talk about my story a bit and talk to someone that's really like-minded and he's doing some really good work over there in that pod. So I'd highly recommend anyone go over to YouTube, type in Further Your Lifestyle, check it out on Spotify, hit those and keep an eye out for my episode. I'll make sure I share that on my socials because that was something really exciting to share, a bit about my journey kind of thing, and hopefully it inspires some others to potentially start their own businesses and stuff. So as we're coming up to the start of a new financial year, it is a great time to start a business. If that's something you've always been passionate about doing, or, quite often a lot of the business owners I do, they start from the 1st of July, record keeping wise, it's quite easy. It gives them 12 months to, get their head around things. So that is always a good time of the year to start a business. So yeah, make sure, and I've spoke to a few people in the last few weeks that are starting businesses 1st of July. So I'm excited to help them with that. So that's definitely an area that I can help with is, if you've got an idea, chuck me a message and we can jump on a call and jump on a Zoom thing and, have a chat and go, okay, is this going to be viable? Run through, okay, well, how much money would we need to make each day, each week, each month to actually, hit a break-even point? So that's some of the cool stuff I can do that, maybe people don't realize that you could speak to an accountant about that. And, I did quite a bit of that, 12 months ago with a lot of, small people that said, yeah, look, I'm thinking about starting this. I want to start something small from home. And, can actually give you that honest feedback and go, look, do you honestly think you can do this per day or per week? Because if you can't, you're not going to be able to cover your costs. And, then we might need to, do we need to pivot and do something else? Or is there something else you could think about just to, it might not be to get rich, but to generate enough income to cover costs or maybe to replace your wage. So lots of cool things that you can start thinking about starting a financial year. So I do have one question here. So with rentals, is it house repairs you can claim and improvements or renovations? So I'll try and dissect that. So repairs, as I said, so if you do repairs and, your property's rented out and, something goes wrong and you've got to repair something, you need some plumbing work done, or, a faulty globe goes and you need to get an electrician in. They're going to be claimed as repairs and maintenance. So they'll go on your tax return, they'll be claimed as an expense. No different to, your council rates and stuff like that. So they're really easy. Where it gets more complex is when you're actually doing a renovation. So say, okay, you're renting it out, but at the same time you strip out the bathroom because you want to upgrade it. Suddenly we're now talking a renovation, and this is going to be a capital work, and we're going to have to depreciate this. So this is going to be claimed over a number of years. And even though, and this is where people get confused, they go, oh, I spent $10,000. Based on normal logic, they're going, oh, that's a $10,000 deduction. Sweet, I'm going to have a big loss on my property. It's going to offset my other income. I should get a good refund. And unfortunately, that's not how it will work, because if it gets depreciated over 10 years, and even if it's diminishing value, I might claim a little bit more up front. That might only be a $1,500 claim in that first year. So, you might not be getting nowhere near as much of a claim, and therefore, reducing your rental property income, hopefully into a loss position if you're trying to, offset against other income. That's where it can get a little bit confusing. So make sure you check first before you go and do a big renovation if you're doing it with the intention of the tax benefits helping you out. So that's the last case you want to be is, spend 10 grand on something thinking that, oh, well, it should get me 3 or 4 grand extra back in tax, not getting that and then going, oh, geez, I overexpended. I shouldn't have spent that because I wasn't in the financial position to do it. So you don't want to get caught out from a cash flow point of view where you've gone and spent too much, expecting to get, a tax refund to help offset some of that spending, thinking, oh, I spent 10 grand, I'm going to get 4 grand back, therefore it's only going to really cost me 6 grand. And then you turn out you spent 10 grand, you've got $500 back, and you go, oh, geez, I'm 9.5 grand out of pocket. And, and it comes back to, I talk about it all the time, is don't ever just go and spend money just to save tax if it wasn't something you actually wanted to spend the money on. There's no point, and this goes for individual, and we talked about it, tax deductions. Don't go spend $200 on a legitimate tax deduction that you can claim, all to save yourself $40 in tax or something, or $60 in tax, depending on your rate. And then you're going, oh, I didn't really want that, but, I got it back on tax. I think, unfortunately, a lot of people think, oh, I claim it on tax and you get the whole amount back. But that's probably something I didn't cover enough when I talked about tax deductions is, it doesn't work that you go, oh, I spend $100 and I just get that back. That's not how it works. You claim it. You're not claiming it back. It's claimed as a deduction. It reduces your income by that, and you're going to get a potential tax deduction, and the benefits are going to be marginal based on your marginal tax rate. So just keep that in mind. So there is another question that's come through. So what are the benefits of investing in a family trust? So this is something I have spoke to a few people about recently, especially, with this whole crypto boom that's been happening, and people start going, oh, maybe I shouldn't have a family trust. And they just hear the words family trust and think, oh, that's got to be a good thing. That's, I think sometimes people think, oh, anything complex is going to make things better. So the advantages to a family trust is flexibility. So quite often we'll have a discretionary family trust, and that gives us discretion over how that profit is distributed year to year. So we do something called a trust minutes, which kind of outlines how we expect to distribute those profits. But it does give us a bit more flexibility with who the beneficiaries are. So beneficiaries can be relatively broad in a trust, especially when it comes to families. You might have, husband and wife that are the main beneficiaries of the trust, and therefore their children may come into it as secondary beneficiaries. They may have parents as well and siblings, and it just depends how the trust is worded. But, you're investing within that trust. So you might hold, a couple $100,000 of shares that pay dividends. You might own a property in there as well. And at the end of the year, when that tax return is done and we've got our profit, we can potentially distribute in a way that's going to make sense tax-wise. So it does give you a bit of flexibility compared to, say, an investment that's all held in one name. So if we take a real basic example and we've got, $100,000 of shares, and we'll say, okay, they're paying out, we get a $10,000 dividend. If they were all invested in one person's name and say they're already earning, a couple $100,000 kind of thing, that's all going to be declared in their own personal tax return. They're going to pay tax at the highest marginal tax rate. And you can't do anything about it. That's who the asset owner is. That's who the income is there for. That's who's entitled to receive that income. And therefore, that's who will pay tax on it. If we hold that same asset in a trust, potentially we can distribute that to, someone they might not be working at all. So they may be utilizing that tax-free bracket and they may be paying no tax on it. So we might save ourselves a few $1,000s on that. You can see, obviously, as investments grow, this could give us more and more flexibility. So it's just going to depend on number of beneficiaries, what type of income, and what type of assets we've got. But obviously, the downside to trust is, one, it's more complex. So we've got a whole nother, trustee, and we've got a whole set of rules here that we've got to make sure we're following. We've got to make sure we're doing accounting for that, potentially accounting for that, a tax return for that. So it's obviously going to be more things, and therefore you're likely going to have costs to set up the trust. There's going to be cost to actually set up the deed. And obviously it's going to depend on how complex you want this as to, whether you're actually going to have to get lawyers to individually do this. Depends which state you're in as to whether that deed needs to be stamped. Are you going to have someone actually physically do this setting up for you? So therefore, is that going to be another fee? And then you're going to have ongoing increased accounting fees. If you're wanting to do anything complex, you're going to have ongoing legal fees. There's all these things. Now, they're all kind of some of, your worst case scenario where you're going to have huge amounts of fees. I've seen plenty of clients that, have a basic trust set up. It doesn't cost them, might cost them, between $300, $500, $1,000 kind of thing to set it up. Their extra fees a year might be a couple $100s in accounting fees because, they do a lot of the groundwork themselves to, do the calculations, and suddenly might be costing them $1,000 a year kind of thing to run, maybe even less. And they're going, oh yeah, but I'm saving $5,000 in tax. Or the other side to trust is that some of the more long-term estate planning is, you can set up trusts that allow things to not be accessed to a certain amount, or, they can be almost a generational trust where assets remain in the trust and get passed through generations. So there are different things that you can do within a trust. So the biggest thing, I suppose, with trust is probably flexibility, but you've got to weigh up as, don't just set up a trust just for the sake of it. So we've got another one. Can I distribute associated expenses within the family trust? So you're likely going to have expenses of that trust. So the way it's normally going to work is we've got our income, obviously, of the trust, as we talked about. So, for example, we've got dividends and stuff. And then we've got all the expenses of that trust. So it might be those accounting fees, or, it could be asset investment fees, or if we're running a business, obviously, we're going to have business expenses. And then we're going to end up with a taxable income. So we're going to end up, at the end of the day, we might have $2,000 of that. So that's going to be your income less your expenses, and that's what's going to be distributed. So the thing with a trust, if you end up in a loss position, you can't distribute those losses. So we can't go, okay, this trust is making no money and we've got expenses and therefore we want to distribute them. We can't distribute those expenses if it means it's a loss. So those losses will be carried forward to future years and they can be offset against future income. But we can't necessarily distribute a loss from a trust. So again, it comes down to a bit of tax planning. And when we set up these entities, we want to make sure an entity is set up with some forward thinking. And there's different ways that things could be when you first start a business. And, I've dealt with clients where I go, okay, we've got a business that's profitable over here and we've got a trust that's making a loss over here, but we're unable to utilize some of that in some situations. So just having a bit of a plan. If you're speaking to an accountant, make sure you're getting an overview of your entire picture. That could be, especially if you've got kids and you've got business and you've got property. Let's make sure everything is in the right spots, because having things in the right entities and the right structures and the right beneficiaries to things and who owns what is really important. And that is one of the easiest ways, I suppose, that you can save money. Like, that's the thing. So, and we've got one more question here. So, last trust question: can a business be run within a family trust? So, yeah, definitely heaps of businesses are run through family trusts. So again, they have obviously all those benefits we just talked about. So that ability to be flexible with our distributions. Now, we do have to be careful with some types of businesses that we've got a thing called PSI, so personal services income. So you do have a little bit careful. You can't just, as an employee, you can't just set yourself up as a contractor, invoice out to, your employer as such, put it all through a trust and distribute those profits. Unfortunately, there are some things that safeguard against that. So you can't just, use it for tax avoidance as such. But there's definitely ways we can legally minimize tax through a trust, and running a business is definitely an option through there. One thing I do like to mention, and trusts are quite popular, especially with small businesses. But one thing that I do like about companies, so just jumping onto, companies are a different structure, but companies have got more flexibility. They don't have to distribute all those profits. Now, trust doesn't have to distribute all of its profits, but then there'll be tax payable by the trustee, and it's going to be at the highest marginal rates normally, or equivalent to that. So there's not normally any benefits to leaving income in a trust and paying tax at the highest rate. So yeah, but a business can definitely be run through a trust. So that's been a cool little chat there on trust. So I think thanks, Michael, for that, because it's quite an interesting topic that people just hear of trust and either they go, oh, it's complex, so therefore it must be really good, or they go, oh, it's complex and I don't want to talk about it. So, and especially, and that goes for investing. A lot of people are starting to invest, and when you're starting to talk bigger figures, you want to have some planning. Go, okay, maybe a trust isn't going to be overly beneficial to me now. It might be in a break-even point, by the time I take into fees with the minimal benefits I'm getting tax-wise. But, in 10 years' time, when I go, okay, my partner might not be working, and therefore we might want to utilize the lower tax brackets for her, or things like that you could do some forward thinking. Or, you don't want to be in this position where you've got all these assets in a personal name. You go, oh, now I want them in trust, and you have to sell them off and pay capital gains on them there. Whereas if you put a bit of forward thinking and some planning into it, you could. So always try and have an idea of whether it's business or investing. It's, what's a bit of a longer term view? Where do I see this in 10, 15, 20 years time? Where do I see my life situation in that time? And what's kind of some things I could put in place now so that I'm not having to make costly changes down the track? Because, these things might add up. Saving yourself $5,000 a year on tax over 10 years is $50,000. And I'm sure if we offered you $50,000 up front, you wouldn't say no to it. So a bit of forward thinking and planning on not just where you see the business or the investments, but also where you see your own life, and then being able to pivot on when things change is a really good idea to be thinking about. So I'm glad we've managed to get through this. I'm glad that hopefully the audio and video has got better as we've gone through the night. So I do appreciate everyone that sat through. We've had quite a few on, so I really appreciate the support. As always, make sure you check out some of the other videos on my channel. So I'll keep on those occupations. Please let me know what occupations you want me to cover. Go to that video, the teacher's one, even if it's just to drop a comment on that. And hopefully we'll have another video out on Sunday. I haven't decided on a topic for that one. That will be recorded tomorrow. And we're almost at tax time. So hopefully these will continue during tax time. So even if you're jumping on going, I'm trying to complete my own return, how do I do it? I can hopefully give you a bit of guidance. So again, thanks everyone for watching, and I'll see you again soon.